Hello everyone, welcome to week 1 lecture videos once again, and now we will talk about chapter 3, the financial services industry, other financial institutions. So in chapter 2, we talked about depository institutions, the dominant financial institutions, and in this chapter we will talk about other financial institutions. So we have 3 learning objectives in this chapter. So in these 3 learning objectives, we will essentially talk about life insurance companies, general insurance companies, and superannuations, the 3 other major financial institutions operating in Australia. So first of all is life insurance. Life insurance allows individuals and their beneficiaries to protect against losses in income through premature death or retirement. By pooling risks, life insurance transfers income-related uncertainties from the insured individual to a group. Okay, so essentially, the life insurance company takes advantage of law of large number. So they sell policy to a large number of policy holders, and the risk is spread over a large number of people. In the event of an unfortunate premature death of a particular individual, then it will be borne. The risk is borne by all others. As of June 2014, Australia had 28 life insurers with a total asset of 281 billion compared to $85 billion in 1990. The life insurance industry in Australia is highly concentrated. So, which means that the largest 5 groups in Australia account for about 81% of the industry assets, and the top 10 representing 94% of the asset as at December 2013. Since financial sector reforms in the 1980s, just as life insurer took up banking licenses, banks have entered in the life insurance market both by establishing insurance subsidiaries and through acquisitions. There are 2 basic classes of life insurance as set out in the Life Insurance Act in 1995: superannuation business and ordinary business. Superannuation business is conducted by life insurer as well as the specialist superannuation funds. The ordinary life insurance contracts are sold on an individual basis, and an owner of an ordinary policy, I mean the policy holder or owner, makes either periodic or premium payments throughout the life of the policy, or a lump sum or single premium paid at the contract commencement. Despite the seemingly enormous variety of policy types, there are essentially 4 basic types of life insurance contract. The first 3 are traditional forms of ordinary life insurance, while the last contract type, introduced in 1970s and 1980s, provides a savings vehicle that competed with other financial institutions' saving products and also met the growing demand for retirement income. The 3 traditional contractual forms are term life, whole of life, and endowment life, are not as attractive as savings purposes as the newer products for saving called investment linked contracts. Uh, the key feature of these contracts are, for example, term insurance, a pure life insurance contract with no savings element, in which the policyholder receives a payout contingent on death during the period of the insurance. Whole life, on the other hand, protects an individual over entire life. In return for periodic level premium, the individual's beneficiary receive an insured sum on the death of the individual, plus any bonuses that have accrued throughout the life of the policy. Endowment, a contract which combines pure insurance with a savings element and guarantees a payout of the sum insured to the owner of the policy if death occurs during the sum agreed term, and at the end of the policy term if the insured person lives to the endowment date. Because of the long-term nature of policyholders' claim and the need to generate competitive returns on the savings elements of the life products. Life insurer invests in assets at longer end of the maturity spectrum. Now in this table, we see the life insurance asset and distributions over the time from 1990 to 2014. There are several structural changes, particularly three of them can be found out. First, while the property holdings were a significant part of the portfolio of life insurance in 1990, which was about 15.7% of the total asset, investment in these assets group represented less than 1% in 2014. This is what I am talking about. Second, investment in equities and unit trusts increased from 28.6% in 1990 to 77.8% of the total asset in 2014. So you can see that equity investment has increased substantially. Finally, life insurance investment in long-term securities has reduced from more than 19% of the asset invested in 1990 to 8.6% in 2014. The move from property investment and fixed income securities to equities and unit trust is a reflection of the shift in life insurance business, both within ordinary business and the superannuation business. You can see the distribution of the total revenue of life insurance, where 62.5% is essentially the investment revenue, whereas 31.2% is the net policy premium. 5.7% is the management service fee that the insurance manager provides. The regulation, the insurance industry is subject to APRA supervises life companies registered under the Life Insurance Act 1995, which, like the Banking Act 1959, provides for the protection of the interests of beneficiaries. And in the case of life insurance, the policyholders. APRA has the power under the relevant legislation to authorize and revoke authorities of insurers, both life and general, to make prudential standard, issues enforceable direction, and to inspect insurers. So that's the end of our discussion about life insurance. In the next video, we will be talking about general insurance. Thank you.